It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of '87, but it still left traders and investors shell-shocked.
You saw it, didn't you? It was down some.
Why? How come?
I don't know. Bad day.
Bad day for you?
Another one, yeah.
Yeah, I know.
Too many in a row.
The plunge was sparked by a jump in US inflation, the fear a bigger hike in interest rates the only remedy. It was enough to force the Dow Jones down 616 points, a drop of 5.5%. The fragile technology stocks even harder hit, the Nasdaq index in freefall down nearly 10%. It lost a quarter of its value in just 1 week.
Once this body started...
Well, you know, I will give a little advice, and that's don't make any sudden moves. If you don't need your money soon, leave it where it is. I mean, people really often make the worst possible move, which is when there is a sell to get involved in that panic and to say, oh my gosh, I've got to move my portfolio around. Now is not the time to do that.
Well, I'm more positive, I think, than either Marty or Mary, in that I think that we've probably had 90% of the decline. I think it's possible we could go lower here over the next week or so, but I think sometime between now and maybe the end of the year or the end of the first quarter, that you'll see the market in excess of its recent high.
First of all, price-to-earnings multiples are extremely exaggerated. Price-to-value multiples are extremely exaggerated. The psychology is extremely exaggerated. I have found the market to be overbought for a long period of time, but let's be quite honest, it has been a bull market. It continues to be a bull market, and you can write this down. It will continue to be a bull market until it stops. We are at that point where it's just, I mean, what more can one say? It's been an amazing move thus far, and the best...
Yeah, right? You was farting in bathtubs and laughing your ass off. Yeah. To be a moron.
Yeah.
To be moronical.
Exactly. To be a moron.
An imbecile.
Yeah.
Like the dumbest motherfucker that ever lived.
When I was playing the character.
When everybody knows you never go full retard.
What do you mean?
20 stop, Bill. 20. 3 times.
Sell, sell, sell. The sounds on Wall Street. Investors say some kind of decline was bound to happen. As the Federal Reserve slows down the economy, companies can't make as much money. And that's where the problem lies.
You saw a lot of panic selling today, a lot of assets being sold off that really, nothing wrong with them. They're good assets. The value is there. People just having a panic now, and they're just dumping stuff willy-nilly all over the place.
Some investors we caught up with say they're not worried at all. But even some of the old faithfuls are suffering. So what should investors do? Experts say leave your retirement accounts, your 401ks, alone. Instead, look at your stocks and decide where to cut your losses. As a final word of advice, relax.
And try to be patient. Try to be patient and take it easy. And if you happen to have assets that are doing well, be happy about it. If you have assets that aren't doing well, evaluate them and decide whether you should keep them or not.
Carmen Castellanos, News Channel 10.
It's all part of the natural operation of the stock market, and they say safeguards are in place to help prevent declines of more than a few hundred points. Those safeguards even work sometimes.
Hit that level again, I think people are going to say, wait a second, down 4 or 5%, let's start looking. I've been listening to the guests. There's a lot of stuff that has actually gotten interesting that wasn't interesting on Thursday. Markets do get cheaper as they go down. There are issues, obviously, but we talk endlessly about how the 10-year, the interest rates went up. Well, can we look at them for a second? They're going down. We talk constantly about how the market's overvalued. It may have been overvalued on Wednesday, but there's things now that are not overvalued. We have a situation like Wells Fargo that's so powerful, it can pull every bank stock down. And by the way, it is amazing that the Federal Reserve basically woke up and said, hey, the largest domestic bank, boom, let's just cut their earnings. Let's just take their earnings, not just the people with their earnings. So we'll probably revisit this Pat's crash again. But remember, it's done on no volume. It's done because of machines. No one even has time to think to buy. Someone obviously screwed up and put in a big sell order, and it goes down like that. And, we should get used to that because we're up a lot on a percentage basis. But let's just not forget that the markets showed the same lack of class and power and honesty and truth that we have seen in every kind of one of these flash crashes. It's not different. The market got phony again. It's a shame. but it can't handle the volume and it can't handle this level of selling. Opportunities come when the market breaks, and the market just broke again. We haven't seen it break in a long time. It's too bad.
Jim, let's
means you don't have the faith of God.
Yeah, yes, I do. God has removed the venom from my blood and the blasphemy from my heart.
It can go on for a lot longer than people think, right? Everyone always says, you know, bull markets don't die of old age. There's no time limit on this. It's when...
And as this market continues to grind higher, there's no shortage of people calling for a top, sort of the idea that we've come too far, too long, etc. However, let me tell you one thing. Bull markets do not die of old age. Furthermore, it could be...
It's like the Energizer Bunny. It just keeps going and going and going. It is the second longest bull market in S&P history. That's the good news. And the good news is bull markets don't die from old age. But there are problems developing in this market.
Yeah. What do you see?
Hey folks, it's true, bull markets traditionally don't die just of old age, and the reason I wanted to bring that up today is because over the past few years, and actually most recently just over the past week or so, as we had a little bit of a dip in the stock market, I've seen a lot of people come out and just kind of already start calling the end of the bull market. So I wanted to give you guys a little bit of perspective of how bull markets actually tend to end. Before that though,
each other. We could have a market that surprised everybody to the upside, sort of 2019, 2020. And I'm getting increasingly inclined to think that's going to occur.
A couple quickies here. First of all, from your know-how, how long will this go? What's your horizon here for the bull?
Oh, I've got at least another year, maybe 2 years for this bull.
And so it would be up, what, another 15 or 20% or greater than that?
Oh, more than that. Yeah.
Second,
he sees maybe another decade of gains for this bull market. I mean, Stephen, listen, I respect your views very much, but I'm a little bit wary of a decade of gains. How do you get to that?
Well, let's go through.
You know, it was about 20 years ago, it was the 60s really, that you know, we just seemed to be stuck at 1,000 or below 1,000 on the Dow in the 70s. And then the great bull market started in the early 80s, and it really got going in the early 90s. I don't think the market's going to go back down to 1,000, 2,000. Could it see 7,000 on the Dow now that we're almost at 11,000? Yeah, it could. But then it'll probably see 15,000 by 2005.
15,000 by 2005.
Yeah.
That's so another, what, 50% gain?
Yeah, another 50% gain, I think, is actually a very conservative forecast. And that's mostly because I think that the market is a little overvalued and is due for correction. But I think we are in a great bull industrial revolution for the global economy and a great bull market in stocks.
Epstein is saying the current bull market has 16 more years to run, possibly?
Liz, absolutely. 16 more years. Secular markets can go for 21 years on average. 1946 to 66, we had a secular bull market.
Define secular for our viewers.
So secular bull market is the opportunity for real expansion of the market, where people are taking advantage of consumer purchases. There's more money in the consumer's pocketbook. There's more technology. There's more growth. And that keeps expanding. People are willing to bid up the price of stocks that you wouldn't think they'd bid up over time.
I mean, look at this. It's definitely going to be...
I'm not normally described as perverse. But you've got to be perverse to say the market's going to crash. It may correct. It may have a major correction. But with low inflation, low unemployment, low interest rates, strong corporate earnings, I would be a certifiable lunatic if I said the market was going to crash.
You could well call Richard Quest eccentric, but no one would ever accuse him of being certifiable. Over the last decade, the BBC's US business reporter has covered the stock market crash of '87, the jailing of Ivan Bursky, and the spectacular end to such former masters of the universe as junk bond king Michael Milken. And now, from his perch high above Manhattan, Quest watches the new era.
What you've got now is that this money machine, the internet, the information technology revolution, it's a hell of a mouthful to say, but it's a very profitable mouthful worth saying. The money is flooding out of Wall Street like the dam has burst. It is going into every nook and cranny, every avenue and street, every restaurant, every clothing store, every apartment hunting building, every limousine company. This is not a fad. This is a revolution underway that's affecting the way we do business and live our lives. And that's why it's so profitable.
But because the first phase was so long and that middle grinding phase you see is so long, unless we hit the wallop, that third phase is going to be long. And as we've said now for several years, this is, unless we hit that wallop, going to be by a good notch the longest bull market in history.
I ain't got a good brain.
I think you've got a fine brain, Jack.
You make me happy.
Cryptocurrencies coming under pressure today as concerns grow over the prospect of further regulation from China and South Korea, two of the world's largest Bitcoin markets. The move in Bitcoin has been notable. It's lost almost half of its value. The fear is that regulators will clamp down on Bitcoin trading, and that will reduce overall demand for the cryptocurrency. There are also questions as to whether U.S. regulators will follow suit. The SEC has addressed initial coin offerings and the risks associated with investing in these products, but it hasn't addressed Bitcoin directly. Bitcoin now trading just around $10,000, but the sell-off is not confined to just Bitcoin. Ether, Ripple, Litecoin, other cryptocurrencies also under pressure. Block Tower Capital's Ari Paul, though, says what we're seeing right now is a healthy correction. We'll see if he's right.
Depending on where you're looking, there's been some talk of the cryptocurrency going to zero. Here was Squawk Alley yesterday.
A very significant, I would say maybe a third chance that Bitcoin goes to zero. Now, that doesn't mean that people can't have fun. Yeah, absolutely. I mean, it's completely possible.
What would it take to take Bitcoin to zero? Because that sounds outrageous to me.
Yeah, well,
Josh, you can't be this fucking stupid. I'm sorry. No, kids aren't stupid. Just say what you see, okay? Say what you see.
I think the most vulnerable group in society are the relatively unsophisticated retail investor, for the simple reason that they have less understanding of what is going on. They may not always know precisely how and when to get out of a market, as opposed to more sophisticated financial firms.
Ordinary investors and ordinary people tend to suffer when bubbles burst. They get suckered in right at the end. The four most dangerous words in investing are this time it's different, and it never is.
There are several similarities. One is that there's always some sort of financial contraption that gets out of control. We think it solves some sort of problem, but there's always a financial contraption.
I think it's the first case where the market collapses in part because tools have been created that the people who are using them don't fully understand, financial tools. And in this case, it's portfolio insurance, which is using, the basic idea is you use these things that have been created and are now traded called financial futures, S&P futures, to hedge yourself. And the way you do it is you sell it as the market goes down. And if you think about it, if you start selling it as the market goes down, you sell more and more as the market goes down. At some point, you've completely sold out your equity exposure. So in theory, at some point, you've put a cap on your losses by doing this. And a lot of people had bought into this idea of this is how you hedge. You hedge dynamically by selling futures. Well, that works if one person is doing it. If everybody's doing it, then what happens is the market goes down and everybody sells. So the market goes down some more and they sell even more. And a doomsday machine is created. So here was, I think,
several similarities. One is that there's always some sort of financial contraption that gets out of control. We think it solves some sort of problem, but there's always a financial contraption.
Corporate earnings have grown at a compound annual rate of 8%. That means they've doubled every 9 years, quadrupled every 18 or 19. That's powerful. Growing dividends can be a symbol of those earnings.
The Fidelity Dividend Growth Fund looks at a company's dividend growth as a sign of financial strength. See what Fidelity Money Management Excellence can do for you. Get the fact.
Who's looking after your money? You do have goals to reach. Are mutual funds getting you there? How do they see things? At Janus, they look for opportunities one at a time. Not sectors, not categories, not trends. Just great companies to invest in, no matter what the market's doing. You can find them if you look hard enough, and Janus does. Get there.
And then the mutual fund scandal happened. And I remember when it first started, when inkling of the scandal first started happening, I remember going to Matt Fink, who was the director or the head of the ICI at the time, and saying, hey, how come you guys aren't coming out with anything on this? He went ballistic at me over the phone for this, and he was just outraged that I was even bringing it up. Of course, it had just started, and not too many companies were involved in it yet. Well, it turned out to be a really big deal, and eventually, of course, the ICI had to come out and make statements. But by then, it had just kind of snowballed. And every story I wrote for, I would say, a year and a half, 2 years, was about the mutual fund scandal. Every single week there was some new facet involved. There were new companies getting involved in it. There were bigger losses. Then the regulators started piling on, and there were fines. I mean, it was crazy for the mutual fund industry, which, by comparison was pretty staid up until the mutual fund.
Similarities. One is that there's always some sort of financial contraption that gets out of control. We think it solves some sort of problem, but there's always a financial contraption.
Big bank, small bank, I like to make money. All right? Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it.
How can these underlying bonds be as bad as you say? It wouldn't be legal.
Nobody knows what's in them. Nobody knows what's in the bonds. I've seen some that are 65% AAA rated, that I know for a fact are filled with 95% subprime shit with FICOs below 550.
Get the fuck out of here.
You want me to really blow your mind? When the market deems a bond too risky to buy, what do you think we do with it? Take a guess.
I don't know. You tell me.
All right. You think we just warehouse it on the books? No. We just repackage it with a bunch of other shit that didn't sell and put it into a CDO.
A CDO?
Yes, a CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked.
Say that again.
A collateralized debt obligation. It's important to understand because it's what allowed a housing crisis to become a nationwide economic disaster. Here's world-famous chef Anthony Bourdain to explain.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael Burry shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the triple B level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
Well, I just need similarities. One is that there's always some sort of financial contraption that gets out of control. We think it solves some sort of problem, but there's always a financial contraption.
In the race to retirement, there is the Vanguard way, and there is the other way. Other investment companies' average costs are 6 times higher than Vanguard's average cost, and these recurring charges can drain thousands of dollars from your account, making it harder to reach the finish line. Request a prospectus with investment.
The shift from active to passive means that risk is in the hands of people that don't know how to take risk, and therefore we're likely to have like a 1987 air pocket. This is like portfolio insurance on steroids, the way that algorithmic trading is now running the marketplace, where investors are moving from active managers to passive, meaning they're taking the wheel themselves, all at a time when CTAs are running their own algorithmic strategies where they're call it 1.5 times long and half short, and they all believe they can come out at the same time.
The common clay of the New West. You know. Morons.
What the hell is that?
You say the internet is so revolutionary that the usual rules for valuing a stock, such as revenues and earnings...
Nobody knew how to value a .com. Analysts began to come up with all sorts of strange and dubious ways of valuing these companies by the growth in users. You might double, treble your number of users, and therefore you would be worth 2 or 3 times as much as you had been a few weeks back. It had no real logic behind it, but to those involved in it, there did seem to be a method behind the madness.
We ended up valuing equities on the basis of eyeballs and clicks. How many times people looked at a website, as if this was any use as an investment valuation metric. But it's all about justifying the price, not actually analyzing the price.
Behind that big valuation, active users, that drives revenue at social networks. Snapchat recently passing 150 million users daily. Now, that is more than Twitter, according to some estimates, but Twitter only publishes their monthly active users number, which is 313 million as of Q2.
Take it away, Jeff. Thanks, Andrew. Unbelievable. This morning, Twitter had earnings, and they weren't horrible.
They weren't horrible. In fact, what was it? Revenue beat expectations. Their user growth beat expectations. Their earnings per share. Yeah, good stuff for me.
And the stock popped?
Yes.
It's up over 10%.
I never thought I'd hear the day.
I know, except one problem. It's all a mirage.
Well, how is this?
Well, these numbers are pretty amazing. They make no rational sense, really, but Tesla is what I call the sort of ultimate story stock, which means investors care about the story. They don't care about the numbers. They do not care that it's losing. They lost over $500 million last year, may lose $1 billion this year, and they don't really care that GM and Ford are making billions of dollars in profit. The story with Tesla is that they are going to dominate the auto market, that they are going to create the world's safest car, that they are going to take over the battery market, and that they are going to dominate and reinvent the electric grid. I mean, these are all huge markets, and they think Tesla is going to dominate every one of them.
Nonsense. We came here to find the American dream. Now that we're right in the vortex, you want to quit? You must realize, man, we found the main nerve.
That's what